Hey guys, welcome to my channel. My name is Sam. I'm a loan officer and I help healthcare professionals and investors secure home loans. And in this video, I'm going to walk you through a site called Rabbu, which is similar to like AirDNA, where they do investment analysis on Airbnb properties, kind of to see if Airbnb that you're looking at or an address that you're looking at, if you did an Airbnb in that neighborhood, would it be profitable? So I'm going to do a breakdown of this and kind of walk you through the site. And just so you know, I'm going to have more property breakdowns, and my job as a loan officer is to do these breakdowns because I like to see what types of loans would fit for the type of property that we're looking at, and you can see for yourself what the loan process looks like and what type of loan may be best for you, since you might be looking for a primary residence or an investment property. So this site is similar to AirDNA, where you have market data, you have estimates of Airbnb revenue, and they have all that here for you. And if you go to their tools section, they have a really nice calculator that we're going to check out pretty soon. You can also look at Airbnb properties for sale. I was looking at a property in the Fort Lauderdale area, and you can see these are all the properties that are for sale. I was looking at this one. Let's take a quick look. Now, some of these numbers you have to take with a grain of salt because you also have to do your due diligence. You can't just go by what the numbers say, but this just gives you a baseline of what the potential value is, the return on investment. But I like to do the numbers myself based on some of the information that I get from here, and then some of the other resources that I like to check out. So Rabbu likes to pull data. I'm not sure where they pull their sources from, but they say that they use algorithms to determine the return on investment, the calculations that we're about to see. They say they use these algorithms to determine all these numbers, but like I said before, you have to do your due diligence. So here's the property. It's being offered for $469,900. So as we go through the photos, seems like it's been pretty much remodeled here. As you can see here, that's a pretty nice kitchen, a lot of open lighting. The bathrooms look pretty modern somewhat. It's a nice kind of like lanai sort of back porch area here. And there's the floor plan and the backyard. So it's a pretty decent backyard space. It doesn't have a pool, which would be good for Airbnb. But I can see people that would use this would be like your remote workers, your people that are working remote, that are traveling, people that are probably going to stay for like a month, 2 months. They don't need a lot of luxurious things because they're not on vacation, but they're just coming to work. So you can probably invest a little bit more to kind of make it into a place where someone that's working remote will feel like it's a home. So this is just the pictures. We're going to go back to the listing. It's a 3-bed, 2 baths, 1,100 square feet. It's on a 0.2 acre lot. Now it's saying it's a cash on cash of 29.2%, but I think it's less than that. And annual revenue is $93,765. So here is where it's located. It's in the Melrose Park of Fort Lauderdale. And I'm going to take you through the calculator to kind of show you exactly what those numbers will look like. But here's some of the details here. Projected revenue, $93,765, like we said, has a cap rate of 15.7%. If you're not sure what cap rates are, you can Google it, but basically the higher the cap rate, the higher the risk, but there is higher reward. The lower the cap rate, the lower the risk, but the lower reward. So that's kind of how I think about it. And here's some market data that they give you based on that zip code, what the average occupancy is. Now that 41% is pretty low, but that's because we're in the summer months in South Florida where we tend to be in low season, and I'll show you a graph of what the high season looks like and what the low season looks like. So in this zip code, it also gives you the number of Airbnbs currently. So right now there's about 348 Airbnbs in this zip code. And here they have the average daily rate, which is $252, and they have comps. So this is some good data here that you can look at and you can use to kind of do your analysis and see if it's a property that you want to buy or the zip code that you may even want to buy in. So those numbers I take with a grain of salt. What I like to do is I look to go into the calculator. So if you go into their tools section, they have calculators here. So it's an Airbnb calculator. And I click on that and I use that information to kind of get a little bit more accurate information and details. So now it gives us this information. I'm just going to move over here. So now it's saying that the annual projection is 55,586. Remember, we were seeing it was telling us about around 96,000. So this kind of gives you more real-time data, if you will, but again, you still have to do your research and kind of verify these numbers. So occupancy rate is 51% and average daily rate is 217. So they're much different than what we looked at on that listing. So here's that season projected revenue by month I was telling you guys about. And you can see here, during the winter months, it's popping in Florida. So high season, you can see that's where most revenue is generated. And during the low months, where occupancy is way less, you're gonna make a little bit less than that. So here is a graph of all the Airbnbs in that area and what they're charging per night. So you're looking at about $150 to maybe $200 a night on average, right? During the low season. I'm sure it's higher than that, and obviously during the high season, but right in the lower months, the low season months, these are the rates that you'll typically see. So they were asking, that list price they were asking, $4,699, right? So we're going to do the calculation here and see on the listing it said the cash on cash return was around 26%. So the real time numbers we're getting here is saying that it's 9%. And remember, we had a cap rate of 14. Now our cap rate is 8.9%. So this is currently right now, if you were to purchase this property right as of this point in time. So it's giving you the total investment. So this would take into account down payment, closing costs, those type of things. And then you get your revenue of how much you would make per month on this Airbnb based on the nightly rent or the nightly rate, your expenses. So this would be here your maintenance, if you had HOA fees, utilities, insurance, those things. So it's a nice little breakdown of expenses. So these numbers you can plug in and get some more accurate data. And then here is financing. Now this financing is based on you putting down 20% with the average loan cost of 2.75% and with today's interest rate of 7.25%. So just keep in mind, this is the interest rate that they're giving you. So you'd have to plug in your own interest rate based on what you are pre-approved for or what you qualify for. So just know that rates could change and your monthly payment could look a little bit different than this. So they use what they call a DSCR loan to finance these type of properties. They're investment loans, and I should have a video on that, and I'll link it somewhere in here at some point in time. But your upfront equity, this is what you're putting down, all the costs maybe to furnish the Airbnb. It comes to about $117 and $240, right? They're saying your net operating income is $41,587 a year, right? So you're generating $3,466 a month. So net leverage net cash flow is $10,529 a year or $877 a month. So you're cash flowing $877 a month on this Airbnb, where your initial upfront equity was $117,240. So what you want to know is how long. So this is your cash on cash return, right? How long will it take to get this $117,240 back? So if we do the calculation, I got my trusty calculator here. We take that $117,240 and we divide it by the leverage net cash flow. So this is after you pay off your expenses, everything. So we divide that by 10,529. We get 11 years, guys. So it'll take 11 years based on the numbers that we're seeing here to get that $117,240 back. So I don't know about you guys, but I don't want to wait 11 years to get $117,240 back. So you would have to play around with these numbers. So what that looks like is maybe your revenue has to go up, right? Or maybe you lower your expenses, or maybe you get different type of financing, or maybe you put in a lower offer. So instead of offering $469.9, maybe you offer, $420, $430. So these are numbers that you got to play around with. But I'm showing you this just to break down what this looks like and what you would need to do your due diligence. So if we go on Airbnb, kind of showed you guys here, this was that area. Because I like to go on Airbnb, you can kind of look and see what the rates are for Airbnbs in that neighborhood if you wanted to kind of look, and you can see what they're offering. Because two something a night that 217 a night, okay, what do these Airbnbs look like for them to get 217, right? Do they have a pool? Are they, nicely furnished? What do they look like? See here, you got this nice Airbnb here with the pool. Some of them are nicely furnished. They have all these amenities here that will attract people to their Airbnb. And then you can look here. These are the average nightly rates. So you can get that in real time, and then you can use that as part of your due diligence. Now, what I always recommend, like most of these loans are DSCR loans, right? So the income calculation is different because they go by rental rates. If you wanted to finance a property like this as an investor, I always recommend DSCR loans, which stands for debt service coverage ratio loans. The income calculation is a little bit different than like some of your primary traditional loans like FHA and conventional. With DSCR loans, what they look at is the rental data. They look at rental comps to see if the rents in that neighborhood or in that area of that property is enough to cover the debt service. So to qualify for a DSCR loan, all you need to have is a 640 FICO score. Loan to value is 80%, so that means you put down 20%. You need to have at least 3 months in reserves, or at least show it in a bank account, prepayment penalty options up to about 3 years. So you can say, for instance, you buy the property and then you want to refinance in 6 months or a year. Based on how you set your prepayment penalty options, there will be a fee to do that. All right. You can close in your LLC, which is good because then you don't have to have it in your personal name. So if you have a real estate business and you have a bunch of different LLCs that you use for liability and asset protection, this is good so that you don't have any of your properties in your personal name. And with these DSCR loans, you can finance up to 20 properties. So now I'm going to show you what rental comps look like and what you need to see in order to qualify for these types of loans. Remember, the rents in that area have to be able to cover the debt service on these loans, otherwise it will not qualify. So let me go ahead and show you what that looks like. So let's just say you aren't able to do Airbnb in this property, or you buy the property and the county says, or the city says, you know what, we're banning Airbnbs, but you're still responsible for that mortgage, and now you have to do a 12-month lease on this property. Will you cash flow if you do a straight rental if they decide to ban Airbnb and then cover your expenses? So that's why it's important, if you do a DSCR loan, is to see what rental rates are looking like in that area. So that way you'll know if you had to do a 12-month lease that your rents will cover your debt service. So I like to go on Zillow, and I did a little line here or boundary area of where that Airbnb was located. So that Airbnb was located here, and then I just scan through what are the rents going for in this area. So we had a 3.2 that was about 1,100 square feet. So if we scroll down, here's a 3.2. This is 1,300 square feet. So that's two. They're asking 2,700. Here's another 3.2. They're asking 2,700 here. So right now we're seeing that the average rental rate for property that we were looking at for 3.2, 1,100 square feet is around $2,700 because we just found two already. So here's another 3.2, it's 1,200, so that's $3,000 here that they're asking, 3,100 for the rent. Let's see. Here's another 3.2, 2,700 here. Here's another 3.2. So this may be, okay, this is 2,000 square feet, so we can't really use that as a comparable kind of. Maybe it has a pool. So that's kind of how I do that. So we can see already that the rental rate is going to be between $2,700 and $3,000 if we had to lease this out for a 12-month lease. So the financing here was $2,588. So there you have it. So if we had to do a 12-month lease because they banned Airbnb in that zip code or that county, we'd at least be able to cover our debt coverage. Because here they're saying the financing is $2,588 based on that interest rate and all the other factors like closing costs, the type of loan that you get, and all those other things. So that's what I wanted to show you guys. So basically, it'll take 11 years based on the calculations that they're giving us here to get your return on investment on that upfront equity. So do you want to wait 11 years? That's something you have to think about. Obviously, it's real estate, so it will appreciate, but you can't based on appreciation. If you're in the Airbnb business, you're obviously looking for cash flow. So that's just something you have to think about. So I'm going to have more breakdowns like this, so make sure you like and follow. And yeah, if you have any questions on this, definitely let me know in the comments, and I'll see you guys on the next one.